So welcome. Thank you so much for joining us on this Thursday for our presentation today, State of the Specialty Insurance Marketplace with Paul Smith of HW Kaufman Group. Paul, thank you for being with us today. First off, my name is Rachel Lieblein-Jabala. I'm the Programs Manager at the Spencer Educational Foundation. My pronouns are she, her. And to introduce you to the foundation and what we do, our mission is to fund the education of tomorrow's risk management and insurance leaders. And we work to fulfill that mission through scholarships to students, internships to fund risk management internships, internship grants rather to fund risk management internships, and grants to universities for experiential learning opportunities and RMI curriculum development. And we're so excited to offer this webinar series this summer. This is the 7th webinar in our 10-part summer series. I can't believe we're well over that halfway mark already. The summer is flying. And thanks so much to all those familiar faces and names for joining today, and for those who are joining for the first time. Welcome and thanks for coming. I have a couple of housekeeping notes. As I mentioned at the top of the call, if you haven't done so already, please feel free to introduce yourself in the chat with your name, where you're calling in from, and your university or organization, so we can get to know you. I also encourage you all to turn your cameras on if you feel comfortable doing so. It's great to see some faces and see you all sort of live and in person in this virtual format. Second piece is that this meeting is being recorded, so it will be posted on the Spencer website after the fact, so you can access any information you hear today afterwards. And also, if you have any friends or colleagues who weren't able to join today, please feel free to share that link with them after the fact as well. And last piece is that Paul will be entertaining questions throughout the presentation. So if you hear something, you have a question about it, a thought, a comment, please feel free to use the chat to ask your question. Or if you feel comfortable asking that question live, you can raise your hand, we'll call on you, and you can unmute yourself and ask that question throughout. And the last thing is I am going to now pass the microphone over to Mariah Propus. It's my pleasure to introduce Mariah, who will then introduce Paul, and then we'll kick off the session. Mariah is Senior Vice President of Distribution and Broker Partnerships at RT Specialty Group. She is Spencer's immediate past board chair and has served on the Spencer board since I think 2012, Mariah, if that's correct. Yep. She is, yeah, great, awesome. She is a fearless leader and advocate for our foundation, and jumped at the chance to introduce Paul today. And so with that, Mariah, I'll pass the floor over to you. Thanks for being here.
Great. Thank you so much, Rachel. And first of all, hi to all of our participants today. I want to congratulate you and commend you for joining this webinar in particular, but also our ongoing webinar series. We're really proud not only of the topics and the content, but also the top leaders that we're able to pull from the industry into this time with us today. I don't normally do the intros for these, but I asked if I could today because I just thought today was such a special opportunity for all of you to spend some time with one of the people I admire the most in our industry, and that's my friend Paul Smith, who's Corporate Senior Vice President with HW Kaufman Group. Now, I know all of you can read Paul's bio and see the really rich experience and expertise that his storied career will lend to our time together today. But I wanted to point a few things out that maybe wouldn't be as obvious to all of you when you read Paul's bio. So I think this is just really important perspective and relevance for the views that Paul is kindly going to bring to all of us today. So again, I've known Paul, I've worked with him for about 20 years, and true success is defined in a lot of different ways in our industry, and I'm sure all of you are learning that and putting together your own definitions for what success truly looks like. But I think Paul is someone that really has struck such a unique balance of professional success in a variety of settings, and as well, really maintain an ongoing commitment to service and community work and subscribing to values and philosophies that resonate with all of us inside and outside of the risk and insurance sector. So that's really important to know about Paul's background. His experience specifically, really cool that Paul has what we call big broker experience. So he has worked for very large publicly traded companies, but as well, today, he has some very relevant, really interesting private company expertise. So when you think about your careers and the type of employers that you want to work for, Paul has worked for all of the above and on both ends of the spectrum of some of the top and leading employers that we have in the industry today. So I think that's really a treat to hear from him there. You know, he has both domestic and international experience. There's a lot of people that spend most, if not all of their careers working in the United States in our domestic insurance marketplace. Paul really has a global view and as well a true view on what being client-centric truly means and having a client-facing acumen. So there's a lot of different roles in the insurance and risk management industry. Many people spend their careers guessing what it is our clients or our insureds really want. But Paul really has met almost every notable risk manager associated with many of the largest companies on a global basis. And I think that experience is really something that we can't pull from almost anyone in terms of spending time with us. So that client-centric acumen is something really that you only gather from a lot of experience in the industry. And I think that'll be some great perspective for us as well. Last but certainly not least, I'm going to tell you that Paul is not only super interesting and smart, but he is a really fun person. So, you know, going to a lot of industry events, you can tell who is really well liked in our industry by the groups that surround them. So Paul is a really fun person, and we've had a chance to spend a lot of time at industry events. He's got just a really interesting background, and I would suggest to you when you get to the Q&A and you can get Paul to talk a little bit about himself personally, talk to him about his passion for cars. That's not the only thing that makes Paul interesting, but he has some really cool hobbies and really great interests outside of the industry as well. All of that contributes to just making him a super well-rounded professional leader and someone whose experience and perspective is going to be just invaluable to us today. So Paul, thank you so much for making the time for Spencer, for our webinar series, and certainly for your personal commitment to Spencer. We really appreciate it.
Well, that's just terrific, Mariah. Thank you so much for that warm introduction. I chuckled a little bit. I thought you may embarrass me, so I'm glad that you didn't. We'll leave that for the Q&A as we go through here. I would also just want to say, hey, thank you to all of our participants today. I really appreciate your commitment to spending some time this afternoon in what I'd like to describe as dialogue and discussion and really Q&A. I have prepared a deck which will, kind of keep us on track. We'll talk about some specific items, but let's not wait to the end to kind of jump into the Q&A, right? If you have a question, raise your hand, put it in the chat box, whatever makes good sense. Just as I kind of, I'll flip the chart here in a minute and kind of give you a quick introduction of myself, which Mariah has already done, but a few other things I wanted to point out as well. As we were preparing for this call today, only 20 minutes ago, myself and Rachel got on a little bit early, and believe it or not, my cell phone rang. And I excused myself and I took a call from an individual on my phone, and I hung up and I said to Rachel, how ironic is it that the person that got me started in the insurance industry in 1985 is the person that just called me on a completely unrelated topic? I thought that was pretty amazing. So that person is my oldest brother, and he started me in the industry in 1985. He was very actively participating with a broker at the time, and I kind of followed in his footsteps, and here we are in 2021. So I thought that was fairly ironic. The other thing that I think is really important to point out here too is that I really take this industry to heart. Many of my friends, and I say that word very carefully, many of my friends are industry members, folks that I've gotten to know over the last 35 years in networking and so forth. That's number one. And number two, it is so important to me, this industry, that I actually have one of my children very actively involved in the industry, and she's with one of those large brokers that Mariah mentioned. So it's a really, really important industry to me. And of course, I thought ironic that my brother called me only a few minutes before we got started here. So quick introduction, over 3 decades in the P&C industry, primarily with Aon and Willis, 17 years at Aon, 17 years at Willis, currently with the H.W. Kaufman Group, which is the parent of Burns and Wilcox. Not everyone's heard of the Kaufman Group, but we are a private family-owned Detroit-based holding company that has various different component pieces that make up our holdings. The most notable, of course, is Burns and Wilcox. We have some other MGUs. We have an A-rated insurance company. We have a premium finance company. We have a bunch of other related insurance-related parts of the organization. My technical background, and Mariah alluded to this, is I'm really kind of a casualty person. Casualty placement, London, Bermuda, Switzerland, Zurich, you name it, anywhere in the world to get deals done. I worked on some of the largest accounts, as Mariah had referenced, and primarily with putting together their excess casualty placements. Currently, and most importantly, I'm with I'm responsible for carrier relations, claims, and some other strategic initiatives within the HW Kaufman Group. I'm based here in New York City. I say here, although I'm sitting in the den at my home, which is in New Jersey, but New York City is where I'm based, and very excited about getting back out on the road. My first business trip is next week, and then I have one a few weeks after that, so kind of getting back into things. Thought it would also be important to kind of point out a few of the industry areas that I'm related with, that I'm affiliated with. So JSC is an acronym for the John Street Club, very well-known organization based in New York City, about 80 years old. And it's really about networking, and a really fabulous organization that I'm a past governor of and have been a member of since 1994. IBANY is the Insurance Brokers Association of New York, very similar. I'm also proud to state that I was recently appointed to the board of the Northeast section of the IICF, which is the Insurance Industry Charitable Foundation. So I'm excited about that. And then more specifically, with kind of deals day in and day out that we do here in the specialty and ENS marketplace, is we are members of the Wholesale and Specialty Insurance Association, and also the Council of Insurance Agents and Brokers. I could go on, but a fairly wide group of industry-related affiliations. Important, once again, that you think those through. I think it's really important that we get out and network. It's really all about networking. So let me kind of jump into what I was hoping to kind of cover today with an agenda and an overview. I'm going to talk about really kind of 5 different topics primarily. I want to talk about, as it relates specifically to the specialty ENS space, I want to talk about rate, capacity, terms, conditions, new market entrants, general trends, and then I'm going to deviate from that a little bit, and I'm going to provide to you what I'm going to call just kind of 35 years experience of hints, tips, and observations of things that I think are really important for anyone getting underway in the insurance industry. And then I have Q&A at the end in conclusion. But once again, let's try and do that Q&A as we go through the session. I don't want anything to get lost. And sometimes when we're having a conversation, it's really important that we kind of get it out on the table right away, because we all learn from each other's questions, and if it's in your mind, in all likelihood, it's on someone else's mind as well. So without further ado, let's just kind of jump right into the state of the specialty and ENS marketplace. Let's start with the overarching kind of a topic of the fact that rates are broadly increasing in all P&C lines. I'm sure everyone reads the news, you've seen that. That's not really the case though, historically speaking. That really started, in my humble opinion, toward the end of 2018 and has been ramping up ever since. Prior to that, I would say for the decade or so prior to 2018, it was actually going in the opposite direction, right? Rates were going down, exposures were remaining somewhat consistent or going up, hence meaning that, if a rate reduction goes down and exposure goes up, really it's a significant change in premium as it relates to the risk that the carriers are underwriting. So that went on for quite a long time. I think part of the reason why we're in the market conditions that we are today, but just my humble opinion. Second bullet here, that the surplus lines premiums were up by 21.9% through mid-year, is so relevant. This was breaking news. Today's Thursday. That came out late Tuesday and was published yesterday in various periodicals. So state stamping offices are essentially the various states in which surplus lines filings surplus lines taxes are filed. So that information is aggregated, and we can look at that. So a fairly interesting number there. It's almost 22% through June 30th of this year. We're seeing surplus lines premiums increase in the United States. Big number by any standard. The other thing that I thought would be interesting to talk about here is that not all accounts are the same, right? Not all, everyone's seeing a 21.9% increase by any stretch. It really needs to be segregated and looked at by various other criteria. The Council of Insurance Agents and Brokers that I referenced a little earlier, they recently came out and showed that large accounts, and they didn't define large or medium or small, but I think we can all use our imagination, right? Let's call it Fortune 500. Let's call the medium, everything below Fortune 500 down to, I don't know, $100 million in sales or thereabouts, right? There's no magic there, or there's no industry standard on how we measure those things, but I think those are good barometers. So Fortune 500, below Fortune 500 down to about 100 million in sales, and below that would be small. So interestingly enough, the larger accounts are seeing the most significant increases, according to the study that was conducted by the Council of Insurance Agents and Brokers. Another important ingredient, and one of the reasons why we can't broad brush what the rates are, so to speak, it really needs to be looked at very, very specifically. I'll continue on there and talk about certain LOBs, lines of business, that have seen the most significant impact over this period from, let's call it late 2018, certainly more momentum in 19, clearly in 2020, and continuing on here through 21. The most significant lines that are being impacted are umbrella and excess casualty. I could go on and on and on because of this being my technical background as to why it's in this space here, and I'm happy to entertain any questions you may have on that topic or other ones. Cyber, you don't need to be in the insurance industry to read the press every day. Something else is happening. Someone else is getting hacked. It's a tough world out right now on cyber, and it has such a far-reaching implication. I was down in Virginia back in mid-May when we had the cyber attack on the gas pipeline. And I was thinking to myself, and I didn't want to fly, the pandemic was not quite where I had wanted it to be. So I said, I'll just drive down to Richmond, Virginia, not a big deal. Well, as I'm leaving here in New Jersey, I'm thinking to myself, how am I going to get back from Richmond, Virginia? There's no gas there. There's no fuel in the line, in the tanks, anywhere down there to be had. So cyber can really impact this all the way around, personally, professionally, and in any other way. So a significant exposure that the industry, I think, needs to really get its arms around in a much more robust way than it has thus far. It's a new exposure and something that we need to really double down on. Directors and officers. A lot of speculation, if you will, for lack of a better term, as to some of the decisions that have been made primarily over the last 18 months by large organizations as we went into lockdowns and things like that. If those decisions that they made are perceived as somewhat incorrect, well, guess what? There's going to be a shareholder suit. There's going to be a suit by some type of a third party that's going to come in and ask them to justify the decisions that they made. Hindsight's always 20/20. Directors and officers, they need this coverage in place in order to make the decisions and the tough decisions that they make day in and day out. And then finally, cat-prone property, right? So once again, I think it's pretty obvious that catastrophes are increasing. We had more hurricanes in 2020, named storms in 2020 that we went through the entire alphabet. It's off to a robust start again here in 2021. Knock on wood, hopefully not to the same degree. But let's also keep in mind more than just hurricanes when we talk about catastrophe-prone property coverages. The news this morning, the news yesterday, the poor folks out in the 12 most western states with the wildfires. That's a catastrophe, a property catastrophe, and something that really was not on the radar of many individuals in the industry 5, 7, 10 years ago. So it's becoming more and more of a true cat as we move ahead. So on my further comments on rate, I kind of end with a few questions here. And so carriers have seen this increase in their shareholder equity, which is by most measures a very good way to kind of determine the health of an insurance company. In addition, of course, to rating agencies like AM Best, Standard & Poor's, Moody's, et cetera, but shareholder equity, which is publicly available information for most carriers. That's a really good barometer as to how they're doing. And they're doing really well over the last couple years because of those rate increases that I mentioned above. So I'd like to kind of pause there and throw a few questions out, and that is it sustainable? The answer is, who knows? We will see. Time will tell as to whether or not it is sustainable. And then, one of the things that I learned when I was in university, when I was in college, was the simple ironclad law of supply and demand, right? So when supply goes up, prices go down. When demand goes up, prices go up. But right now, the supply side of the insurance industry, and I'll talk about that in a couple slides later, is very, very high. So will that ironclad law of supply and demand have an impact on carriers' ability to maintain that behavior that they've had over the last couple of years? So once again, time will tell on that one. We'll see and how things progress. I'm going to pivot over now to capacity, and that's really where I talk a little bit more about some of the new limits that are coming into play, the carriers changing their appetite, some of the new market entrants, which we'll talk about a little earlier. In this marketplace, unlike earlier marketplaces, there's no kind of scarcity of capacity. When I started in the industry in the mid-'80s, I can tell you that regardless of how much premium you had to spend, there was just not enough capacity to fulfill placements on very large, complex accounts. I came in on the tail end of that, and I don't believe that the industry has seen that type of scarcity of capacity since then, and hopefully it won't again. So although there's, carriers are kind of pulling back their capacity a little bit in the second bullet there, and they're deploying it very carefully. I think it's important to underscore the fact that there's no scarcity of capacity overall. Generally speaking, most clients can get their deals placed, their placements completed with appropriate limits of liability, whether it be on the property side, the liability side, or any other side of the house. So capacity is out there. It's just that it takes more hard work on behalf of brokers to get that placed through doing some unique things that are really required in order to get a deal placed, and that is you have to layer deals, right? I don't know if anyone's familiar with layering, but if in the past a client needed, let's say, $25 million worth of umbrella limits, you could go to a carrier and probably fulfill that. One carrier, one policy, one limit, $25 million, deal's done. Well, in today's marketplace, you need to layer that up. So you get a 5, then you get a 5x 5, a 10x a 10, in order to kind of find the $25 million in limits that the clients need. So there's some unique things that are happening here, and a whole lot more work. I want to underscore that, a whole lot more work on behalf of carriers, a whole lot more work on behalf of brokers, and a whole lot more work on behalf of the entire industry to fulfill those placements. It's not as easy as it was at one point in time. The carriers are also adjusting their appetites and redeploying capacity into areas where they anticipate a greater return on investment. Just like any business that you're in, everyone wants to maximize their return. They want to get the most for their investment. And carriers today have the ability to pivot rather quickly and exit a particular line of business, exit a particular geography, exit a certain class of business, if it's not kind of generating that return on investment that is really important for their shareholders or their other constituents. So it's really important to understand that the marketplace is perhaps more fluid than it ever has been, with carriers changing their appetites, kind of jumping into the marketplace, jumping out of the marketplace. I have a recent example. I won't say who, but two very large, significant, well-known insurance companies within the last 10 days, okay? So two very large companies, one exited a particular line of business. They said, we can't get the return on investment. We're out of here. We're done. Effective October 1st, you need to find a new home on all those renewals after that point in time going forward, and no new business submissions starting today. Well, guess what? At about the same time, another very well-known established insurance company said, hey, we're entering this space. We hired so-and-so who used to be at a different company. We're getting our filings in order. We're getting our rating in order. And we should be ready to start accepting submissions toward the end of the year. I found that fascinating. I found it absolutely fascinating that two very well-known large insurance companies said, can't make any money at it. I'm out of here. The other one said, we hired someone. We're building the team. We want to do more of this business. We think it's really good for us going forward. I think it's fascinating how you can have such diversity from two, once again, very well-known places. And how did they come to that answer? They came to that answer through the last bullet that we have up here. And that is, I've seen just an amazing change in the industry's ability to kind of use quantitative analysis to measure pro forma results, right? So they're going to use some historical information from the one carrier and say, no, we don't think it's right for us any longer. The other carrier who hasn't been in this space came in and said, all right, we have a lot of data, a lot of information. We can quantify that and we can run some pro formas on that. We think we can do well at it. So I think the point on that particular bullet, the last bullet on this slide, is that capacity ebbs and flows, and it's going to continue to ebb and flow, and carriers are working much more diligently on utilizing their kind of quantitative analysis and information that's available to them to assist them in making those decisions, which, by the way, are not easy decisions. They can be very challenging and difficult decisions. So I'm going to continue on there and talk a little bit about terms and conditions, T&C as I like to call it. Interestingly, in this marketplace, in this challenging marketplace that started in late 2018 or so, it's more than just rate. Carriers aren't just asking for more rate on the same deal. They're managing their exposure and they're managing their outcomes and so forth by getting more rate. We talked about it in a previous slide by reducing the capacity in some instances, but they don't want to put up as much. So if a carrier put up 10 million on a lead umbrella before, maybe now they're only putting up 5 or 2.5 or whatever the case may be. So they're managing their exposure through rate, through capacity, and also through very diligent underwriting of terms and conditions. So a policy is nothing more than a promise to pay at the end of the day in the event of a claim that's covered under the, I always like to say, 4 corners of the policy. 4 corners of the policy are what make up the terms and conditions of that policy. So in this marketplace, we're seeing carriers introduce some things that perhaps they haven't in the past that they feel are really important for them to kind of get back to that level of profitability that was missing at one point in time. So what are they doing? They're introducing sublimits. As an example, and this isn't an all-inclusive list by any means, but introducing sublimits. So okay, so you have a $10 million limit on a property policy, but guess what? This particular peril is sublimited to 1 million, 2.5 million, 5 million, whatever the case may be. So there's kind of lower limits within the overarching policy limit. Coinsurance, essentially a way of making sure that insureds have their skin in the game, that they're participating in any losses that may come in. That's traditionally and even more so now being utilized with particular perils that carriers feel are more challenging to get their arms around than others. I'll throw an example out to you, and we talk about it a little bit in a few slides down the road here, but convective storms in the Midwest, right? So Kansas, Missouri, Colorado, places like that. We've seen, or even earlier this year, I'm sure everyone saw the big freeze in Texas and Louisiana that occurred in February. Those type of atypical convective storms that are coming through some non-traditional cat-prone areas are very, very, very costly. So carriers are generally including some type of a co-insurance clause on those things there, which is essentially, insureds now have more of their skin in the game in the form of co-insurance, which is kind of in the form of it's kind of like a deductible, but a little bit different than that. And then exclusions, right? They're putting a lot more exclusions on policies than ever before. Of course, the obvious one that we all know about now is communicable disease, right? Prior to March of 2020, there was not a whole lot of communicable disease exclusions on policies, unless you were a hospital perhaps, or you were some type of a healthcare clinic, and the carriers felt that there was a real exposure there. Well, now, guess what? Restaurants are generally seeing communicable disease exclusions. Manufacturing facilities, other kind of way outside the historical norm, are seeing exclusions that perhaps they wouldn't have seen at one point in time. So really important that we look at policy terms and conditions. We read the four corners of the policy. We understand what those terms and conditions are, because that's where the promise comes in to pay the claim when it comes in, and they do come in. There's no question about that. So it's a whole lot easier to have the discussion today about what the terms and conditions are than to have expectations that something is covered when in fact it's not covered down the road, ultimately, when that claim comes in. I use a term here. It's maybe just my personal term, but window dressing coverages. In the height of the soft market, right, which went from the mid 2000s through to 2018, there were carriers kind of throwing in all kinds of like coverages, like, hey, we need to get this deal done. We want to differentiate ourselves from someone else. So they were expanding terms and conditions and putting in, I call it window dressing coverages, but hey, it ultimately had some type of a value. Whether it came into play or not, who knows? But those window dressing coverages and the throw-ins, if you will, are no longer available. They're really being looked at very, very carefully. And then perhaps one of the most important elements of today's discussion that I think is really, really important is that historically, in the height of the soft market, we saw a creep, I'll call it, of coverage is kind of finding their way into general liability or umbrella or excess that really didn't belong there. Employment practices liability insurance. It's a whole standalone marketplace for that. It belongs in its own marketplace. It's typically claims made trigger or an occurrence reported trigger. It doesn't belong in a GL policy. It doesn't belong in an umbrella policy. In my opinion, it has its own marketplace. Environmental. I recall the days when environmental was not excluded under a GL policy. Of course, now that's its own industry as well, and rightly so. Cyber, more recently, are there elements of cyber cover under a GL? Perhaps, but it really belongs in its own marketplace where they understand the exposure, understand the terms and conditions, and can underwrite it accordingly. And then elements of professional, very broad brushed, but let's just say you have a couple of accountants on board and you need some accountants professional liability, or you have some real estate development within your organization and you need real estate agency. In the old days, you would kind of tuck that in under a GL policy or tuck it in under an umbrella policy. Those days are pretty much over, and rightly so, and I applaud that. What's happening with that coverage? It's finding its way into the market where it belongs. Just like the rest of the world, we're becoming more specialist in what we do. We're becoming much more kind of focused on where we should be, and we're not just one size fits all. And I think that's the right thing. By the way, a lot of that business is also finding its way into the specialty and E&S marketplace where it belongs. The other creep that we had, I talk about that creep, there were kind of things creeping into the marketplace. The other kind of creep that we had back in that period of time, say 2005 through 2018, was that a significant amount of specialty and E&S coverage and placements were creeping into the admitted marketplace. Well, many carriers have doubled down on that over the last couple of years and said, nope, it belongs over here. It belongs in the E&S side of the house. It belongs through distribution through wholesale brokers. It doesn't belong in the admitted marketplace. It doesn't belong in the retail marketplace. And once again, rightly so. That's where it should be. But that creep over a 15 plus year period, kind of created that soft market, which we really needed to amend. So let me talk about some new market entrants. I don't know what you folks read in the morning when you wake up, but I'm a bit of an insurance junkie. So I read Business Insurance and the Insurance Insider and PNCinsurance.com and, all of these other things. And wow, all the time, there's new capacity coming into the marketplace. And where's that capacity coming from? Generally speaking, it's coming from private equity firms. It's coming from pension funds. The Canadian Pension Fund, one of the largest pension funds in the world, is a significant owner and shareholder of various different insurance entities, whether it be brokerages or insurance companies. So non-traditional equity is finding its way into the marketplace. And it's coming from others as well, hedge funds and and others. We talked about this a little bit earlier, but incumbents are adjusting their appetites, entering and exiting the specific areas. I used that reference of the two carriers earlier. I think that's really important to keep in mind. So, a new market entrant could potentially be, oh, it's an existing carrier, but they haven't written that line of business historically, or they haven't written in that particular geography historically, or something else. So new market entrants can be incumbents or well-known organizations that are just changing their appetite and moving things around a little bit. We've also seen a surge, for lack of a better term, in the establishment of managing general agents and managing general underwriters over the last couple of years. It's really a more efficient way of distributing capital into the hands of insureds, and carriers are understanding that it can be a much more economical way of going about it. So MGA and MGU increases have been far and wide over the last couple of years, and that's continuing on here. Once again, you can almost read about them on a daily basis. Global insurers demanding a greater piece of the U.S. premium, the lucrative U.S. premium. I recently read, and I'll share this name with you, that Tokio Marine, a very large Japanese-based insurance company, we saw them about 10 years ago kind of enter the U.S. marketplace. They acquired a company called Philadelphia. They then acquired a company called Century. Well, guess what? They're now wanting to get more and more into the U.S. marketplace. I don't have the stat off the top of my head, but if you look at the global insurance premium that's placed, in excess of 50% of that, if I recall correctly, approaching 60% of that premium comes from here in the U.S. So these global insurers that are perhaps not well-known entities here in the States, they want more of that. They want a bigger piece of that pie. So I share Tokio Marine as an example of a carrier that's looking to do more in that space, and particularly with an MGU. The other thing that's been very, very interesting to me, and I've known some of these people, I've grown up with them. There's been some very, very strong industry veterans that have kind of retired early, kind of moved on, doing something a little bit different. Well, guess what? They're dusting off their resumes. They're back. They're sitting there. They're now running some of these new insurance companies that are being funded by the private equity, the pension funds, the hedge funds that I mentioned up in the bullet up on the top there. So they're kind of doubling down, and they're saying, yeah, hey, let me give a run at this. It sounds pretty interesting. And there's many of them out there, and it's really exciting to see some of these names resurface again, and they're going to try to build something really cool again. And then, rebranding and refocused on lines of business, geographies, account sizes, and industries, and so forth. There's some carriers out there that there's one that comes to mind. I won't mention the name, but they rebranded about a year ago. And I can tell you, it's all over LinkedIn now. Before they rebranded, no one was really talking about them. They got a new CEO, once again, someone who moved from another organization over to join them. And he just felt that, we need to kind of get rid of that old name because it suggested a particular geography, and it suggested some other things. So he changed the name of it, and he made it really, really a vibrant name. And they're doing terrific. They've brought new people on board, and just the name alone is underscoring how important it is, how something like that can have such a significant impact. So, really kind of cool stuff going on in all of these different areas here. And I could go on and talk about it for a long time there. But let me talk about trends a little bit, and then I'm going to pause and see if I can, elicit some questions from you all. But these trends are in no particular order, and I think they're all really worth talking about a little bit. Selective underwriting. We chatted about it a little bit, right? Carriers are saying, you know what? I'm not interested in that risk because they're based in Cook County, Illinois. Right? Cook County, Illinois is really tough from a liability standpoint. Don't want to be associated with Cook County, Illinois, not interested. New York City construction, not interested in it. But if you move it across the river to Jersey City, New Jersey, sure, I'll write it all day long. Same exact risk, different jurisdiction, once again, being very, very selective. Extraordinary settlements and verdicts. Wow. I don't know if you guys read yesterday the same thing that I did, but the pharmaceutical industry just ponied up, what was it, 26, 28, some big $1 billion, right, in the upper 20s on the opioid crisis, right? So extraordinary settlements and verdicts, that's extraordinary. That's extraordinary, that type of a number. It's staggering. It's staggering. Not suggesting whether it's right or wrong, just saying it's extraordinary. That's becoming more commonplace. We need to be careful of that. Not careful of that, but we need to be mindful of that as members of this industry. Liberal class action certifications. We're seeing more and more class action suits today than we ever saw in the past, and I think that trend's going to continue. Plaintiffs' bar is very, very strong, and they're coming after the insurance industry. Hence, why we need to really be on our A game here, because those things are going to continue to happen. Litigation funding. If you haven't heard about this one, I strongly suggest you Google it. I don't want to show my personal opinion here, but I find it to be alarming that there's organizations out there that will essentially buy your lawsuit from you, and they'll fund it for you if they think they can win, and give you, just for argument's sake here, say 50 cents on the dollar, and they're hopeful that they're going to get $1 out of a sympathetic jury, $1 out of a settlement or whatever. They're going to take the difference on that, and that's how they fund the next aspects of litigation. So they really are not party to it, but they're buying your potential litigation. I talked about it a little earlier, specialty risk returning to the E&S sector, long overdue, very important. It's where it belongs, and the E&S sector was created for just that reason. We also talked about the next bullet a bit earlier, and that is third-party data assisting in risk quantification. Kind of qualifying risk is really, really important, right? So we have so many things at our fingertips today that we just haven't had historically, right? You have Bloomberg, you have Verisk, you have Reuters, you have LexisNexis, you have just a list of organizations that have lots of good data that they've accumulated over a period of time that carriers are now using to ultimately underwrite individual risks, as well as all the things that you can get off the internet, right? So that, as an individual, you can get off the internet. So, carriers are using a whole lot more than the traditional submission or application that's given to them. They're using a lot of third-party information to assist them in the quantification of that risk. Moving to the top right, risk differentiation is paramount. Over the last year and a half, 2, 3 years since the market started changing, that's where brokers really come into play. They really need to differentiate a risk in the marketplace to a carrier. They need to demonstrate why the ABC risk is different than the XYZ risk. Here's some examples. They put more funding into loss mitigation. They have recognized that they had some loss-leading areas, and they're exiting that business. Number 3, they are handling claims much more aggressively today than they have in the past. It's a priority for the organization. There's so many ways that we can differentiate a risk in the marketplace. Really important, particularly for the brokers out there to do that. One of my really kind of cool and favorite topics here, I'll be chatting with a group of people about this in a few weeks, actually 2 weeks from today, I think. Yeah, 2 weeks from today, on August 5th, I'm doing a webinar on parametric insurance. If you haven't learned about parametric insurance, please, kind of consider joining us. And once again, Google it. It's really, really exciting and interesting. A new way of funding, particularly first-party risk, not so much liability, but a really cool topic, and one that I think you should jump into and learn a little bit more about. Really cool stuff. Quality submissions count. For anyone that's going to be on the underwriting side, it's all about bandwidth. There's more business out in the marketplace today than ever before, because everyone's shopping their renewals. Everyone's shopping because they need to demonstrate that they have the best deal at the end of the day. There's only so much bandwidth with our carrier partners. If they get 20 submissions in and they can only work on 10, guess what? A quality submission is going to find its way to the top of that pile. Enough said. We just can't leave questions unanswered, because if they're unanswered, to the bottom of the pile it goes, you'll probably never get a quote. Carriers are adjusting their focus on driving improved returns on investment. We talked about that a little earlier, exiting certain lines, exiting certain geographies, and things along those lines there. And then, from an emerging standpoint, this list could probably go on for a long time. We talked a little bit about convective storms. We did not really talk about some of the other things in there, though. Longer life expectancy, right? So there's more people on the earth than there ever was before. before, and there's going to continue to be more people on the earth. We're going to live longer. We're going to drive longer. We're going to contribute to society longer. We're going to work longer. There's going to be more healthcare related issues because of life expectancy increasing. Cyber, we touched on that one a little bit earlier there. Global warming, don't want to go down that rabbit hole, but I think everyone realizes that there's some significant exposure there as well that we really need to worry about. And then finally is supply chain. Boy, did we learn about that during the beginning of the pandemic, how the supply chain was so significantly impacted, right? I'm sure, we all go to the grocery store on occasion, and you get there and whatever you're looking for, it's like the shelves were empty. That's just, really, that's the end result of supply chain issues. Today, if you want to go buy a new car, there's not as many to choose from. There's not as many used cars to choose from because of the chip shortage. So supply chain really needs to be looked at very, very carefully because of what I call the knock-on effect, right? It ultimately ends on there's something not being at the shelf in your favorite grocery store because of a supply chain issue that was many, many links on the chain prior to that. So I'm going to pause there. I'm going to ask for some questions. I'm going to have a quick drink of water and see where things go. So anyone?
Great. We have a question from Madison in the chat. Thanks, Madison. Can you please share the details about when your presentation on parametric insurance is? I was going to ask the same thing, Paul.
Sure. So August 5th at I want to say 1:30 Eastern time. And you'll see it if you want to kind of friend me on LinkedIn, you'll see it on there. And I have the distinct pleasure of interviewing the North American head of a very, arguably the largest parametric insurer out there. Similar to Mariah, it's someone that I have the distinct pleasure of having traded with over the last 25 years or so. So I'm really looking forward to it. He's a friend. He's someone that I've known for a long time. And I'm really looking forward to learning more about it. Hold on, I want to, I need to retract that statement. It is not on August 5th. We are doing an August 5th version internally for the organization that I work for. We want to make sure that all of our associates are up to speed on it. And then we're doing an external one with this organization probably a month later. So apologies for for pulling the carpet out from under you there. But once again, if you get me on LinkedIn, you'll see when we do the external session of this, which will probably be in September. I'm thinking out loud here. You can just join us then, okay? Any other questions, Rachel?
So far, none in the chat. Oh, Nicole has raised her hand. Nicole, go for it. You can unmute yourself.
Hi, Paul. Lovely presentation so far. In terms of the rate increases, is it simply because of the hard market, or do you think it's just because of more risk, more exposure to risk?
No, I think it's all about the market, right? So, there's two things that really determine the premium, right? It's the rate and times the exposure, right? So payroll, sales, automobiles, whatever the case might be, right? Number of widgets made. So that's going to ebb and flow, right? That's going to go up and down. The exposure side of the house rate for about 15 years was dropping. So even though, in like 2012, 2013, you could have exposure going up for a client and their rate was going down. They would actually pay less in premium a year later than they did the year before, and they're making more widgets or have more cars or whatever. It's just not sustainable. So I think where we are now, premiums are increasing primarily due to rate. If you think about the last 15 to 18 months in the height of the pandemic here, generally speaking, a lot of exposure has gone down. But the industry, Marsh released their numbers yesterday, Travelers released their numbers earlier this week. The industry is doing really, really well at a time when, generally speaking, exposure has been down. So it's really more about rate at this point. But keep in mind, Nicole, that it's not just rate, right? They're adjusting the terms and conditions as well, right? So they're kind of truncating the coverage a little bit too. So more about rate though is the reason why the premiums are up, not so much exposure.
Thank you.
You're welcome. Anyone else? All right. So we're good to go, Rachel?
We're good to go.
Okay, so I'm going to change gears now. I'm going to get a little mushy on you guys now, and I'm going to tell you about some kind of hints, tips, and observations, right? So I'm the father of a 31-year-old woman who's very gainfully employed in the insurance industry. I'm thrilled about that. It just makes my day. Love chatting with her. I'm so happy that she followed in my footsteps. Is it her passion now? Not quite, but perhaps it will be at some point in time. I encourage everyone, though, to follow your passion. Really, really important. Mariah touched on my passion a little earlier. Hopefully we have a few minutes to talk about that. But my passion is a whole bunch of things, one of which is this industry. I feel really, really committed to this industry. It's been terrific to me. I've gained a lot from it, and I love the opportunity to give back to the industry like I'm doing today. So thank you for that. But I do say that you do need to follow your passion. Whatever that is, follow your passion. The next thing I'm going to say is ask lots of questions. We haven't had that so far over the last 50 minutes, but you need to ask lots of questions. And it's fine. It's fine to ask questions because it's so important. We learn from each other when we ask questions. We learn from the answers because we thought maybe we knew the answer, but the answer is actually a little different. Ask lots of questions. It's really important, particularly in this kind of early stage of your insurance and risk management career. Keep time on your side, particularly in this challenging marketplace. Start early. I talked a little bit before about quality submissions and things like that. We really need to kind of back up the clock here. We're not getting things done 11th hour anymore. We really need to start early, have quality documentation, and have quality discussions, set expectations appropriately. Try to keep time on your side. I know it's easier said than done, but we really, really need to do that. I think the most successful people in the industry do that. The industry is truly global and opportunities exist everywhere in the world. Many of you may want to travel, you may want to do things, you may love to ski and want to be based in Denver, you may, love some type of South American culture and be based in Chile, who knows, right? There's a million things that you could do in the insurance industry. It's all over the world, it's everywhere. As long as I'm on that bullet as well, let's talk about all of the different things that you can do within risk management and insurance, right? You could be a broker, you could be an underwriter, you could be a risk manager for, the XYZ company, right? You could get into the actuarial aspect of things. You could do, which is, more about the science of numbers, right? You do the risk engineer and trying to mitigate losses and make sure that when losses do occur, that they're somewhat not as significant as they might be otherwise. People that have a passion for HR, people that have a passion for accounting or compliance or legal claims, right? The list goes on and on and on and on and on and on of all of these things that you can do working for any aspect of the insurance and risk management community. So really consider all of those different things. It's really far reaching. And by the way, all available pretty much anywhere in the world. So think about that. Dream a little bit on where you want to be and how you want to get there and what you're going to do. The next bullet, find a mentor that you trust and can provide you with unbiased and honest coaching. Well, I had two in my life. I mentioned a little earlier that my brother called me right before this webinar started, and we had a quick chat. By the way, he didn't know I was doing it. He just happened to call me. He's like, "Hey, what are you doing for lunch today?" And I'm like, "Dude, you're retired. I have work to do. It's a Thursday." So, he was my mentor. But, I also had another mentor who said to me, "He's your brother. He can't be your mentor because he's not unbiased, right? I need to be your mentor because I'm going to give you really unbiased advice, right? He loves you differently than how I love you, right? Your siblings, you have to." So I had another mentor who I would meet with on a regular basis, and the coaching and the advice and the very confidential Q&A that we had over the years, I look back on now and realize how important it was and how it really shaped me. And I'm so thankful to this person for having done that. I was lucky. I was really lucky to do that. If your organization that you ultimately wind up with doesn't provide a mentor, a formal mentor program, no problem. If you're at the coffee pot with someone or the water cooler or the elevator bank, whatever it is, and there's someone that you really respect, you like their dialogue, you like their communication skills, you like what they do, say, "Hey, would you mind being my mentor? I could use someone to kind of help me bounce things off of on occasion." And you know what? Chances are they'll probably say yes. So I think you need to do one, whether it's formally through your employer or perhaps informally. Nothing wrong with that. And then, the next two, really important. I know they sound a little bit corny here, but, your interaction and dialogue of today will result in relationships that will remain intact throughout your career. Mariah introduced me, right? Did I know when I was dealing with Mariah 20 years ago that she would be introducing me to a group of, risk management professionals and, kind of in the early part of their career or still in university on July 22nd, 2021? Absolutely not. Absolutely not. But there's no doubt that there's people you're interacting with today, people on this very call here, that you're going to say to yourself 5, 10, 15, 20, 25, 30 years from now, hey, do you remember that call we had? It was so dated, right? It was so outdated, right? We used a Zoom call, right? Now we're doing all these other cool things. It's 2040 or 2050. The people you're working with today are going to be the folks that you're going to work with in the future. It's a small industry. As much as I call it global, as much as I call all of these different areas, it's truly a small industry. I say this term frequently. I didn't put it in the text here, but your reputation arrives before you do. Very important to keep that in mind. And then finally, never stop learning and continuing your education. Read. I'm an insurance junkie. I read things all the time and constantly learning from the people that I surround myself with. So important. Formal education is important, but so is the informal stuff that you can kind of do on your own. So never stop. Really important that you kind of continue down those paths there, whether it be formal, informal, or otherwise, right? There's ARMs and CPCUs and CRISs and, AINS and all these other kind of really cool kind of designations that you can pursue. Don't stop. Really, really important. So that's my story. And I'm going to end there and hopefully if that cues up any more questions from the audience.
We have 2 more minutes before the hour is up, and we have a couple of minutes for those questions to come in. I see Nicole has raised her hand. Nicole, go for it.
Thank you for your presentation, Paul. I just wanted to ask, have you ever considered a career in underwriting, and what led you, besides your brother, into working for Willis and being a broker?
Yeah, so the answer to your question is no. I started in the brokerage side just because, that's what he did and it's the only thing I knew. And, hey, I started off doing certificates of insurance. And we all have to start somewhere, right? And I remember being really proud. I did like 3 certificates of insurance, like my first day or something like that, right? So I did that for a long time, and then I left Aon. So I started in '86. I left in '02 and went to Willis. Maybe it's just familiarity. Maybe I was just, many of the people that I had gotten to know on the buyer side of it, right? The risk managers in the world and so forth, which I would not have, I would have been perhaps a little bit further removed if I jumped over to the underwriting side. So I never considered it, but that wasn't really by design. I think it was really because I was just very comfortable, to be candid with you, on the brokerage side, very comfortable, and wanted to have the ability to continue working with the individuals that I had been working with up to that point.
And
follow-up
one more
question,
follow-up question. Yeah. Sure. What's your favorite thing about being a broker?
Solving issues. When you enter the industry, you think, how boring is this, right? You issue a policy and then, you put it on a shelf and 12 months later, you do the same thing. You update the exposure and so forth. Well, guess what? Clients have claims. Clients make acquisitions. Clients make divestitures. Clients make decisions to move into new areas where they weren't before. Exposures change in the form of, we talked about a little earlier, right? Cyber, supply chain, items like that. So I think the ability to constantly have that type of dialogue about is what we're doing today best for the future, and does it meet all of your risk management needs? The world's changing. Cyber, that wasn't a big topic 10 years ago, right? Environmental was not a big topic 35 years ago. Terrorism insurance was not a big topic prior to September 11th, 2001. So the market's constantly changing. And I think as a broker, you constantly have to have that type of dialogue and discussion with your clients. And by the way, they're changing, right? Hey, we're going to make less widgets, smaller widgets, bigger widgets. We're going to manufacture them in a different part of the world. We're going to do whatever, right? We're acquiring ABC, we're divesting XYZ. It's constantly things going on, constantly in motion. It's a very, very vibrant industry.
Thank you.
You're quite welcome.
That's great. Thanks for the questions, everyone. Paul, we are at our hour mark, and I want to wrap up and just say a huge thank you from all of us at Spencer for being here. Your level of expertise and experience is truly incredible and expansive, and we're very grateful for you taking the time to share that with this group today. And thank you for your contributions to the Spencer community. It's really appreciated.
My pleasure. It's nice to have met everyone. And if you have any follow-up questions or anything, you can either get to me through Rachel or look me up on LinkedIn or whatever the case may be. Okay. Everyone, enjoy the rest of your day. Enjoy your summer. Be safe. And I wish you the best of luck in your insurance and risk management careers.
Awesome.
Thank you,
Thanks,
Paul.
Thank
Thanks,
you.
Rachel. Good to see
Bye.
everyone.
Look forward to
Bye now.
seeing you all next week at our next session, and connect with Paul on LinkedIn so that you can also attend that September session whenever it happens. All right. Thanks so much for being here. Nice to see you all.
Bye.
Yeah.
Thank you.